solve your financial problems with the same kind of thinking that caused them. These words will change your reality because poverty can't survive in a dough chaser's mentality.
The Beat Majors.
So to all my dough chasers, it's time to get this party started now.
I like it.
With your host, Jason White.
Yo, what's up, dough chasers? Your host, Jason White here. I'm CEO and founder of Witness Riches. And, I always like to bring good information to you all that's going to help you transcend financially. And tonight I have something very special for you. We're going to be talking about how to get approved for a mortgage the fast way. But the good news is I have an expert here who's going to be talking about that. And I'm going to introduce him in a couple seconds. But as you come in, let me know who you are and where you're from. And what I want you to do is I want you to ask questions in the comment area on, particular questions that you have when it comes to getting approved for a mortgage. Okay. Whatever questions you have throughout this interview, I want you to ask them in the comment area. And, when we have a chance, I'm going to ask our special guests these questions for you so that you can get legitimate answers. Okay. So tonight is all about how to get approved for your mortgage. Dough Chaser TV is all about helping you basically get the understanding and the mindset when it comes to managing your finances. You are improving your finances and you're seeking a financial advantage. And one great way to have a financial advantage is the biggest wealth creator in America. And that's property. That's having a home. That's having a mortgage. That's basically owning your own home, right? And tonight I have someone who I met a few years ago. I think it was Ann Arbor or something like that. We were partnered, and basically I called him a superhero because he used to be a firefighter, right? And this guy is very knowledgeable, super smart. I think he underrates himself on how intelligent he is when it comes to the mortgage industry and marketing. He did some dope things that I took notes on, and actually, borrowed a couple of his ideas. Anyway, who I have today is a good friend and someone who's going to be able to provide a lot of information to you when it comes to getting approved for your mortgage. My man, Adam Clue. Ladies and gentlemen, say what's up. Adam, say what's up to the people.
How's it going, everybody? I'm Adam. I work as a loan officer. That means I'm the mortgage partner, so I'm the guy that actually puts your loan together. I started out working at a rent-to-own program. I actually currently direct the rent-to-own program. So that's where I kind of got to cut my teeth. And because of that, I deal with a lot of people in credit trouble. I probably look at 1,000 credit reports a year and try to figure out how to get a person qualified that is not ready at the time that I first talked to them and try to get them there as quickly as possible. So, I picked up a few things. And I just kind of want to share that stuff with you guys today.
We appreciate that, Adam. Thank you for that introduction. Before you go any further, let's do a mic check. If anyone listening to this, if you can type 1 for me to let me know that you can hear the both of us, that would be perfect because I would hate for you to miss out on this information. So please press 1 if you can hear us. I need you to grab a pen and grab some paper and take notes because Adam's going to break it down, okay? So let me get that. Let's look at the feedback really quick. Adam, if you can bear with me 1 quick second.
Oh, yeah. No
we got a lot of ones coming in. But we got people from Atlanta, North Carolina, Florida, Kansas City. We got New Orleans in the house. But yeah, we got a bunch of ones. So yeah, I appreciate the feedback, everyone. So Adam, before we get started into the interview, if you can just share with the people your story briefly on how you got started and why you chose the mortgage industry.
Yeah, so when I first got started, I've always believed in home ownership. And I mean, I was a firefighter, and I wanted to own my own home. And when you're starting out as a firefighter, you're not making very much money. And I wanted to buy a house, and I had a bunch of student loan debt. And all I got was no, no, no from everybody
Right.
that I went to try to get a loan. I had to go online myself and look up the guidelines to figure out how do I buy a house. I just couldn't accept. I knew I could afford to make the payments, but they kept telling me that I couldn't, and I just didn't want to accept that. So I ended up going through and figuring out how it worked, talking to loan officers and telling them, no, look, this is what it says. It says that I do qualify,
Right.
and that's how I ended up buying my first loan, my first home. 3 years later, I own 5 homes,
Okay.
and I did it. I did it through still working at fire department job and still having quite a bit of student loan debt. So it's a matter of, when it comes to mortgage lending, I kind of had a knack or tenacity for understanding how to look at the rules and make them fit.
Right.
So after completing my time on the fire department, I got my master's in finance, and I decided to go into an industry related to finance because I felt like I had a knack for it, and I naturally chose the mortgage industry given my background and how I got to where I was going. So that's how I ended up writing mortgages. And then obviously going into the mortgage industry, I decided to direct a rent-to-own program. It kind of was natural for me to go into that route because I already knew how to help people get finance that other people were saying no to.
Right.
So that's kind of where I built my business, and that's where I'm at today.
Okay, I appreciate that. You mentioned that you owned 5 homes. What was the mindset behind that? Why 5 homes? Why did you go into ownership? And do you still have those 5 homes?
So I ended up relocating, so I sold the homes, and so I don't own the homes now. But when it came to it, one of the reasons that I did that is because if you look at, I'm a little bit of an economics nerd. If you look at the history of America, and you see how wealth is built on not on a grand scale of billions of dollars, but people who are just individually wealthy. It's through real estate. They own a home. If you look at the amount of money that you spend on your home, it's your next biggest bill to taxes.
Right.
And if you're taking that money and giving it to somebody else the entire time, that's all you're doing is giving it away. You're not paying any of it back into yourself. Owning a home is the only way to take that big bill that you have to pay and invest some of it into yourself. And what I did was, after I owned my own home, I decided to purchase some more and rent them out and build equity and build more wealth that way. Real estate is always going to be here. It's been here since before we've been a country. Real estate is always valuable. So,
Definitely.
That's why I did that.
Okay. So those 5 homes that you had, you were earning rent payments, basically, right? You were receiving income from that.
Mm-hmm.
Definitely.
Yeah. But more importantly, I was receiving equity.
Right.
So the amount of money that I received each month on the rent did not compare to the amount of money that I received on a mortgage paydown. So once I finally sold those homes, the equity that I had in the properties was much more than what the rent was that I collected.
Definitely. And it increased your net worth, I bet.
Mm-hmm.
Okay, I can appreciate that. So right now, are you a mortgage banker, mortgage broker? How would you define your profession right now?
So we are what's called a direct mortgage lender. A lot of times, and I mean, we can go way into this, and it's not necessarily what we're talking about today, but a mortgage broker, a mortgage lender. The major difference between the two is that a broker shops a bunch of different lenders, and a lender is the person that actually provides you the money. So they're the one that determines you're approved through us, we're the bank, we give you the money. A broker takes your loan and goes somewhere else to another bank and says, hey, I want you to give this person money.
So with the lender, everything is done in-house?
Correct.
Okay,
Yeah.
Definitely. Okay.
There's advantages to disadvantages to both.
Right.
So.
I know that dealing with a mortgage lender directly, aka banker, dealing with them directly, you're able to quicken the process of getting approved for a mortgage, correct? Versus
Sometimes, yeah.
Yeah, versus doing it with okay, exactly. Because the whole point of this conversation is how to get on the fast track to getting approved for a mortgage. And with that being said, what do you what are your typical issues that you face when dealing with people who are looking to get a mortgage?
So with dealing with rent-to-own clients, I get typically two major type of clients. I have clients that have bad credit history, and I have clients with no credit history.
Right.
Sometimes I have clients with bad credit history followed by no credit history.
Okay, say that again.
Sometimes I have clients with bad credit history that's followed by no credit history.
Okay.
And when you have a client with bad history followed by no credit history, what you really have is somebody who had a negative event happen, and a lot of times they give up on credit, and that's one of the biggest mistakes you can make.
Wow.
When you have a negative event happen, your best thing that you can do is get right back on the horse and start getting payment history.
Wow.
Because that's what we're looking at. We're looking at your payment history. Your payment history 2 years ago doesn't matter nearly as much as your payment history over the last 12 months.
Exactly.
Your payment history over the last 12 months make more. We put more weight on that than we do foreclosures, bankruptcies, everything that's happened from years ago. We're looking first at how have you made your payments lately, and that's where a lot of people don't realize.
Let's pause on that. Two things. Last night we had a client call our office. Okay, for those of you who are watching, Witness Riches, we offer a credit repair service called the Seven. And last night we had a client call. We were able to help her get about 20, 25 things removed from her credit. Now, she still had some negatives on her credit report. However, she was upset because her credit didn't improve as much as she wanted it to, right? Now, she's that particular situation where you have bad credit history backed up with no history because she's not doing anything to rebuild, right? And one of the big things that you pointed out was, yeah, you have negative payment history from 2-3 years ago, but what are you doing now to fix the situation? Correct?
Mm-hmm.
Right. And we put a big emphasis on that, and that's insane that a mortgage lender is actually saying the same thing that I say. That's crazy. Like,
well, you're the credit guy, man. I mean,
but they don't believe me. They don't believe me sometimes, man. So it's good to see someone in the mortgage industry actually say the same thing. And what would be your biggest recommendation to people in that situation who have bad credit history?
So my biggest recommendation is to get multiple lines of credit, multiple different types of lines of credit.
Okay.
At the very least, start with one. If you have zero, you have zero credit.
Right.
That's the bottom line. Your credit to payment history. What a lot of people will get recommended to do is go out and buy a car. Which buying a car is not the worst thing in the world, but you can also accomplish the same thing by doing something that's not as expensive as buying a car.
Man,
like buying a credit building. Don't you guys offer credit building products, Jason?
We don't actually offer them. We don't actually offer them, but we share resources that do. And that's crazy because there are some people who will say, "Hey, go buy a car to rebuild your credit." But doesn't that impact a component when it comes to getting approved?
It eats into the amount that you can afford for a home. So we're looking at the total amount of debt that you have or the total amount of monthly payments that you have, and we're comparing that to your income. So if you go out and get a $600 a month payment, that's $600 a month less that you can spend on a home. So you could have went from being able to purchase a $160,000 house to now you're down into the $80,000 mark because you ate up most of your payment with your car payment. So,
hold on, one second. I'm sorry, I gotta cut you off. Are you people, dough chasers? Are you hearing this? Okay, your debt to income. He said that you could. There's an opportunity for you to afford a larger mortgage, for example, $160,000. But due to the fact that you opened up a new line of credit, like buying a car, that could hurt your ability and cause you to minimize your dream. Stop playing yourself. People are playing themselves because they're taking bad advice and they're not really thinking about the bigger picture. Debt to income plays a big role.
I own 5 homes and I didn't have a car payment.
My man.
And it wasn't because I went and bought some Mercedes cash. Because I was doing well, but I wasn't doing that well at the time. It was because I knew that I could buy a nice ride that got me from here to there, and I didn't need to have this payment that was weighing me down for what it was I wanted to do, which was to build my real estate wealth. And I think a lot of times when you're when you're looking at a credit report, or when we're looking at a credit report,
Right.
we see $12 $10 a month payments the same way we see $1,000 a month payments.
It doesn't matter.
It has the same exact effect. So it's the same thing. Now, a car or a loan that you receive is a different type of loan than a credit card.
Definitely.
And my recommendation is for you to have both, because getting an installment loan, which is a car or a personal loan, is one type of credit, and a credit card is called revolving credit, which is a different type of credit.
Definitely.
If you have both of those on your credit report,
It's a good mix.
now it looks like you're managing multiple different types of credit, and you're doing it effectively because you don't have any late payments. So both of those things, I think, when I see someone with both credit reports, both the revolving credit and installment credit, and they've had that for a year after having a really bad credit history, it can make the difference from being in the 600s to being in the 700s.
Definitely. I agree with that 100%. So we have a question from our audience. Color Me Beautiful asks, what if you pay the vehicle off within a year? Okay. I have an answer for this, but I think what they're trying to say is, what if you want to buy a house, but you end up buying a car and you pay the car off within a year? How does that affect you?
So if your question is that you're paying the car off within a year of purchasing a home, we, depending on the type of loan program, sometimes we can exclude the payment if it's less than 10 payments left on the car. So if you have a car payment that's $600 a month, but you only have 6 payments left on it, there are some circumstances where we'll say we don't need to include that payment and to determine so you have to consult with your lender to figure out whether that's you or not. Don't just go paying down a huge chunk of money on a car thinking that that's going to get rid of it for you without figuring out what type of loan program you're getting into.
Yeah, get some counseling. So my answer to that is, whoever you are, Color Me Beautiful, thank you for the question. But if you were to buy a car and your goal is to get off within a year, so let's get this right, okay? You bought the car 2019, 2020. However, you have 5 years of installment payments, okay? 60 months. In your mind, you're going to pay it off within a year. However, to the lender, you have 60 payments that you have to pay on this, right? So you have to think about that and be strategic, because they're not going to go with what you say. They're going to go with what's on the credit report. So by you making that decision, you may delay your chance of getting approved for a mortgage, because one, that hurts your debt to income ratio, and then two, they're not going to try to read your mind and assume that you're going to keep your word. So be careful. That's interesting.
Right.
Interesting. Okay.
And another misconception there related to that is that people will think that if I get a loan and then pay it off quickly, that makes my credit score go up higher. Not true.
Right.
If you get a loan, it's the length of the history that makes it pay off. You getting a loan and paying it off quickly in 6 months doesn't say, oh, this person has a lot. We're not impressed thinking, oh, you got a lot of money, so you paid off the loan quickly. You actually limited the amount of payment history you had on your credit report, so you actually reduced the amount that your credit score increased. It's better to have a loan play out for 2-3 years so we can see that, hey, this person is consistent. They made 36 payments and didn't miss one of them.
Exactly.
That's a lot more impressive to us than paying off a loan quickly. We don't know what happened with that. You could have, hit a lottery ticket and paid that off. That doesn't,
yeah, exactly,
make a difference.
And in reality, outside of buying a home, yeah, that's dope. You just paid your car off in 6 months. However, the lender could care less.
It doesn't matter.
Yeah, if it didn't help your credit, we could care less. Okay, and you all have to think about that when you're making these decisions. Let me see. We got some more questions. I appreciate the engagement, everybody. Let me see here. Smooth Operator asks, I'm hearing that now that you can have an FHA loan to purchase a condo. Any truth to that?
Yeah, they just recently changed the rules. Before, it was kind of difficult to do that, but that's not really related to the credit side of things. But to answer your question, they did make it a little easier now to buy a condo with an FHA loan. It's still not quite as easy as purchasing a home, but it is a lot easier than it used to be starting 2020.
Okay, I appreciate you answering that. It's hard for me to read the questions first and then give them to you, so I'm just reading them as we go along.
No, you're good. You're good.
Okay, I appreciate that. So you were mentioning that your niche or niche, however you want to say that, is rent to own, correct?
Mm-hmm.
Okay,
That's right.
explain that a little bit more to our viewers, please.
So with the rent to own program, basically what we do is we a lot of times, let me start over. A lot of times people's conception of rent to own is that you get into a property, you pay rent for 2 years, and you just hope everything works out in the end.
Right.
And that's a terrible plan, which is the reason why rent to own has a bad rep. With our rent to own program, we take a look at what loan program you're going to be on the fastest track to qualify for first.
Okay.
We take a look at all of your documentation related to that loan program, and then we make sure that you're going to be on track to close within the time frame that you agree upon ahead of time. So the difference is that you're going to know what steps you need to take to qualify versus getting in there and they're leaving it up to you, who's not a mortgage lender, to try to do what you think is best to get financed. I've worked with people that have tried to they say, I've been trying to get a mortgage for 2 years. I'm saying, who you been working with?
Right.
Well, no, I just been, trying to pay down collections, things like that. Well, you haven't really been doing anything. So you gotta work with someone who knows what they're doing so that they can tell you what steps to take versus you taking your own steps, which may be heading in the wrong direction.
Exactly. And there are a lot of janky rent to own establishments out there. And to be honest, your industry does have a bad rep. All right. Sorry, YouTube family and Facebook family. We just lost our audio and somehow the live stopped, but we're back. Okay. Adam, do you remember what you were talking about?
I don't know. I was rambling on there for a while. But
we were talking about.
I think we need to start the next.
Yeah, we were talking about how your industry has a bad rep. But yeah, we can move on to the next point.
But regarding that though, just really quickly,
Okay.
Since the financial crisis, which is largely credit card practices in the mortgage industry, they've heavily regulated the mortgage industry, and you have to be licensed now. So one of the ways that you want to guard against making sure you're not getting taken advantage of is if you're talking to someone that says they're a mortgage loan officer, ask them for their NMLS number or their license number. So you ask them for their license number, and you can look that up and make sure that they're actually a licensed mortgage loan officer. Because we have to go through background checks and credit reports ourselves to make sure that we're legitimate people that don't have a bad rep. So.
Okay. So a way for consumers to protect themselves is to ask for that information up front so they can do their research. A lot of times I find that people go with their gut instead of actually doing research on people that they're dealing with and end up getting taken advantage of. So that's a good point that they ask for that number. You said that MLS number?
NMLS. So N is in Nancy, M is in Mary, L is in Mary, S is in Sam.
Okay.
Or if you just ask them for their license number, that'll, you can just type in mortgage license number into Google and it'll take you to the NMLS website.
Gotcha.
Which you can look it up. So.
Yeah, it's important for you all to do your research before you work with anyone, just to make sure that you're protected, because there are a lot of janky people out here, and the last thing I want is for you to be taken advantage of. But Adam's a good dude. Like I said, he's a superhero. A former firefighter, correct?
Yes, right.
Yes, sir.
One of the best jobs in the world.
Yes, sir. Walking a burning building.
It's a lot of fun, man. It's a lot of fun.
Yeah, that's crazy, man. More power to you. More power to you. That's very intimidating. But anyway, I'm pretty sure that's how you got that full beard, man. I'm working on mine, All right. So let me see here. Dough Chasers, as you come in, please ask questions for Adam when it comes to getting approved for a mortgage. He is the expert. He's here to answer your questions. We only have him for a limited amount of time, so make sure you ask those questions in the comment area, please. Let me see here. So, Adam, you talked about how people can protect themselves. You also talked about how your rent-to-own process is different from the typical janky realtors or providers. But when people are looking to get approved for a mortgage, what particular factors other than credit impacts their ability to get approved?
So, well, other than credit score, we're obviously looking at payment history, or there are certain things that we have to take into account when it comes to collections and things like that. That can get complicated. But when it comes to like outside of credit entirely, we're looking at your last 60 days of bank statements. So we're looking at your transaction history because we have to guard against money laundering. One of the biggest mistakes that people will do is they'll go, oh, I'm going to go buy a house now. I need $10,000. I'm going to take this $10,000 that I have saved in my safe and go deposit it into my bank account. Not going to let you use that. We have to know where money comes from. It's called sourcing it.
Yep.
And cash is inherently impossible to source. So if you have $10,000 in a safe and you want to purchase a home, call a mortgage lender, talk to them. They say, hey, look, I want to purchase a home. This is what I got. It's going to take you a little bit of time to get it the way you need to get it done. But, you just don't deposit that into your account because you're not going to be able to use it.
That's good advice. Very good advice. Or if they do, like you said, it'll take some time, right?
Right. It'll take some time. Well, basically, we look at the last 60 days. So if it happens 60 days before that, it's considered seasoned, and in which case we don't see the deposit, and therefore it doesn't matter to us.
Got you.
So,
got you. Okay. There's a lot of people like that, though.
Oh yeah. A lot of people don't trust banks, and they keep all their cash to themselves, and I understand. But when it comes to getting the mortgage industry, we have to record everything.
Right.
So if it's not recorded,
yeah, I got a couple thousand under the mattress. I gotta.
Where you live at? Where's your address?
Yeah. I almost told you too. That's crazy. I almost told you. No, I'm just kidding. Yeah, my wife, she would gobble that up really quick. So.
But another thing is that we're looking at primarily actually before credit. The most important thing is your income. One of the biggest things that people make mistakes on is they don't record their income. And when I say record your income, I mean record it on your taxes.
Gotcha.
Most of the first time homebuyer programs are backed by some sort of government entity. So if you're not paying taxes, you're not playing the game, and you're not going to be eligible for them. So the self-employed borrowers out there, this saying that they make $2,000. And they're really, making $750,000. It's great that you're making that much money, but
report it correctly.
Because it's not reported correctly. If it's not taxed, if the income isn't taxed, it's not something that can be used. Now there's certain different funky rules there where certain deductions can be added back in, but basically it needs to be recorded on your tax return. If that number isn't on there, it doesn't exist for us.
Yeah. So if you want that $1 million mansion, and on your taxes you're claiming $2,000 or $40,000 income, you may have to amend your taxes and end up paying taxes on that amount of money that you want to claim.
Right.
But yeah, I get that. It plays a significant role in your ability to get the dream home that you want. Is your ability to report the correct income.
Right. Now, there's some programs out there that will use your bank statements. They'll take 24 months of bank statements and use the deposits, but you have to put 10% down, and the interest rates are a lot worse. So there are.
Okay. So again, we're having issues with our live. I do appreciate your patience, everyone. But we're back. We're back. Adam, tell me, who's your ideal client?
So my ideal client has more to do with your mentality than what's on paper. I mean, obviously, not having no income at all is not doable. But if you are a person that makes a living wage and you can make your monthly payment, and you make it, you're responsible, and you know that you're just trying to take care of your family and do that, that's what I'm looking for. I'm looking for somebody who wants to own a home and willing to put in the work to do it. There's not everybody's going to be ready at the same time. I'm going to have some people that'll call that don't think they're ready and they're ready now. And I'll have other people that call and they want to be ready in 3 months and it takes you a year. But if you're willing to put in the work and that's your goal and you're willing to listen and follow those steps, that's what I'm looking for.
Okay. I can appreciate that. And when you're working with your clients, what credit score are you looking for?
So the bottom line score that my company does is a 580 credit score. There are some companies that go lower, but ours is a 580. I try to help you boost your score even if you are there because it's going to save you a lot of money. We didn't really get to go into that, but it does. A 20-point increase in your score can literally make a difference in $1,000 on your mortgage, depending on for the average mortgage. So I try to help you do that. But that's really the baseline for when you can get started to put an offer in on a home and get approved for a mortgage is a 580.
Okay. Okay. So yeah, if you are someone who is looking to buy a home, there's definitely opportunities out there for you. I know, Adam, I know that you have a big reach in Michigan and Florida, but you do have the ability to serve nationwide, correct?
Yeah, our company is in most states. I think there's a couple of I don't think we're in Hawaii or California, but most states we're in, and we can serve those. Anybody who calls in and wants to get a mortgage, we can take care of it. So.
Okay, I can appreciate that. Let's see if we can sneak some questions in really quick,
Right.
Because I don't want the issue that we're running across is our live tool that I'm using keeps cutting us off. And we have to start this live all over again. So I want to try to get some more questions answered before we end this. And to all of our viewers, I do apologize, but we're having technical difficulties, so please be patient. Let me see. So you talked about, you're willing to work with people who have a 580 credit score. We usually recommend that our clients have a 640 so they can save money on the interest rate. But if you can answer for me, how does the score really affect an interest rate?
So whenever you're looking at an interest rate, you're actually looking at the cost you're paying for that rate. So if you let's say that you were getting a mortgage at a 5% interest rate, a 640 credit score person may not have to pay any points on that mortgage. A 580 credit score person has costs. So what you're doing is you're for every amount you raise your score, you're saving thousands of dollars. That's one of the reasons why I tell people to get into credit repair right away. Because if you think you're paying a monthly, I don't know how much I know you have different programs, but it doesn't even compare to the amount that you end up saving on your mortgage with how much you increase your score. If you were in credit repair for 3 months and you increase your score by 20 points, you probably triple the amount that you save on your mortgage at the closing table. Just from getting rid of a couple of things on your credit to get your credit score up 20 points.
Yeah.
If you're in it for a year and you get it up 100 points, you're talking about a night and day difference. You may be talking $5,000 or $6,000 difference, where you can reach interest rates that you couldn't even reach on the other one. So,
right. I tell our clients that all the time. Like, you're paying, our $75 a month for credit repair, but think about how much money you're going to save in interest when you go and get your house. You're going to save thousands of dollars by improving your credit score. So the value outweighs the price. And a lot of people don't think that way, but that's why we have Doe Chaser TV. It's all about the mentality. It's all about how you think about it, right?
I mean, even if you were in the credit repair for half the year, if you were in there for say 6 months, you're talking about $500, and you're talking about saving $2,000 at the closing table. I mean, you can't get that return on investment on anything. I mean, you're talking about 400% return on your investment paying there. So it definitely makes sense to get working on it now. A lot of people wait and they go, okay, now I'm ready to buy a house, and at that point it's too late.
Okay, Adam, I appreciate that. Thank you so much. I do appreciate your time. Adam, how can people reach out to you for your services?
So if you go to my website at www.ownyournewhome.com, you can reach me that way. Also, you can just give me a call. The phone number is 941-444-5563. We're open between 9 and 7 on weekdays. We'll be happy to take care of you.
Okay, give me that number one more time.
941-444-5563. But if you go to the website, you can actually schedule a call for a time that fits best for you. I recommend that being the best way to get a hold of us. So.
Okay. So, yeah, if you're new school, go to the website. As you can see, it's ownyournewhome.com. If you're old school, the phone number is 941-444-5563. So, Adam, we do appreciate your time. Again, his website is ownyournewhome.com and phone number 941-444-5563. Adam, thank you for your time, and we will be having you again on Dough Chaser TV. Thank you so much, man.
I appreciate it, man. Talk to you later.
All right. Peace out, bro.
Bye.
For all of our Dough Chasers, thank you for joining me. It's been a pleasure seeing you all this evening. We're going to try to do this at least once a month. I'm going to try to get more guests. And if you enjoyed Adam, please send me your feedback. Let me know if you want me to bring him back. I'm going to bring him back anyway, but let me know if you want me to bring him back. And let me know if you have any further questions that you want me to ask him for a future episode. And make sure you reach out to him. Again, his website is ownyournewhome.com. That website is at the bottom of the page. And then his number is 941-444-5563. I want to thank you all for joining me this evening. Again, I apologize for the glitches in the live. I'm going to do some research and try to get this fixed. But your patience is definitely appreciated, and the opportunity to influence you is even more appreciated. Thank you so much. I'm out.